Hello friends, welcome to Finavision, your one-stop solution for CFA classes. My name is Shushmita Aditya Mukherjee and this video is part of a series of topic-related videos taken as part of the CFA Level 1 curriculum. If you want to access more such videos and put classes, the links are provided in the description. Keep watching and let's get started.
Modigliani-Miller proposition. What this is all about. So friends, we know something about valuation of a company, right? We already know that valuation or a intrinsic value of a company is the present value of all its future cash flows, right? All its future cash flows. Valuation of a company is the present value of all its future cash flows. Cash flows in the sense it's free cash flows. Free cash flows, right? Now, measuring free cash flow is a separate topic. Right now, we are more concerned with finding out the present value of the cash flows. So, how do we find this present value? How do we find this present value, right? This is the question. The answer is, let's say a company is going to earn cash flows for next n number of years. Next n number of years. And these cash flows are respectively CF1 for year 1, CF2 for year 2, CF3 for year 3, CFN for year n. Now their present values, there is a very simple way to calculate it. The present value, that is the value at time V0, is all these cash flows, CF1, CF2, CF3, till CFN, all these values, each of them discounted to the present time, that is t is equal to 0, right? Discounted to the present time, that is c is equal to 0. So to discount it, if you have read rates and returns, we need a rate of return, right? Let's say that rate of return is R. This R, how do we measure it? This R is basically the cost of capital. The cost of capital, right, of the company XYZ, whatever company we are dealing with, we are trying to find out the value of that company, right? So this R is basically the cost of capital of this company XYZ. How we measure it, we will again get to it in a very short while. Just be with me here. So this R we are using for this present value calculation. So CF1 discounted to present value will be CF1 divided by 1 plus R to the power 1. CF2 will be CF2 divided by 1 plus R to the power 2 plus CF3. This will be CF3 divided by 1 plus R to the power 3. This entire expression is nothing but the present value of CF3, that is cash flow 3. This entire expression, second one, this is nothing but the present value of cash flow 2. The first expression is the present value of cash flow 1, right? Similarly, we add all these present values. We add all these present values to get the valuation, which is the sum total of all the present values of the future cash flows, right? Now CFN, what this will be? It's easy, right? CFN divided by 1 plus R to the power n. Right? Now we add all this up. What we get is the sum total of the present values. Right? Now, Modigliani and Miller, they were concerned with how does the capital structure impact this cost of capital and the valuation. So Miller and Modigliani wanted to understand how a capital structure impacts the valuation and the cost of capital. And they went about it and they derived certain very, very interesting propositions. Right? We will discuss about that. Now friends, value of a firm, this is equal to the market value of its equity plus the market value of debt. This is how we calculate the value of a firm when we are talking about Miller and Modigliani propositions. market value of equity and market value of debt. In shorthand, we can write it like this: V is equal to E plus D, right? Then there is cost of capital, cost of equity and cost of debt. So let's say cost of capital is R, cost of equity is RE and cost of debt is RD. Another thing we use, which is called R0. R0 is basically cost of capital when a company has zero debt. When a company has zero debt. And when there is some debt, what we measure is RWAC, weighted average cost of capital. How we measure it, friends? It is the weighted average cost of equity and cost of debt. So this R0 and RWAC, these are basically two cases of cost of capital R, right? So the question remains, how do we measure return on equity and return on debt, right? Return on debt is, simply speaking, the interest you get when you invest in the debt divided by the market value of the debt, right? It can be 5%, 6%, 7%. We already know at the time of purchasing, right? Because we are purchasing at a certain price and the interest rate is declared beforehand. It can be fixed, it can be flexible, whatever, right? And cost of equity, this has multiple ways of measurement. One way is CAPM, Capital Asset Pricing Method. What is that? That is basically measuring the cost of equity with the help of risk-free rate and market returns. How do we do that? Cost of equity is equal to risk-free rate plus beta multiplied by market return minus the risk-free rate. Beta is basically the volatility of the company, let's say XYZ, with respect to the market. Which basically means if the volatility of XYZ is more than the market, then beta will be greater than 1. If the volatility of XYZ is less than the market, then the beta will be less than 1. How we calculate it? It's part of a separate chapter which we'll discuss when we discuss those chapters, equity investments and all. Here we'll focus on Miller and Modigliani propositions, the assumptions and the subsequent propositions in two circumstances. One is with taxes and another is without taxes. Now friends, to make their propositions of valuation and cost of capital in general market scenarios, they started off with the simplest market format. And for that, they had to make certain assumptions, right? Certain assumptions. We will talk about those assumptions first, then we'll get into the propositions. So let's get on with it. Now the propositions that Miller and Modigliani made were made under certain assumptions or market scenarios. What were those assumptions? Let's get to them one by one. Miller and Modigliani assumptions. The first one is homogeneous expectations. What do we mean by that? Let's say there are n number of investors, all of them value companies in similar ways and all of them have similar expectations of the macroeconomic scenarios, right? When they are valuing a company, let's say XYZ, they are valuing it under the same expectations and they also have same expectations of the macroeconomic conditions, right? This is homogeneous expectation. The second is perfect capital markets. Perfect capital markets. What does this mean? This means that there are no transaction costs and there is no information gap between investor to investor. All investors know the same things. Cost of borrowing is equal to risk-free rate. What do we mean by this? Investors can borrow at risk-free rates. Fourth point, no agency costs. Now friends, in investments, generally there lies something called agency risks. What is agency risk? For example, you are looking to buy a stock. Let's say you are looking to buy a certain stock named ABC. Now, you need to depend or you need to trust that the management of ABC will act in your benefit, that is the investor's benefit. The management of ABC will act for the maximization of investor benefits, right? This is a dependency that an investor in ABC has. If you are trying to invest in ABC, you have this dependency. So this is also a risk. If the management does not act in your favor or act in the investor's favor, then in the long term or in the short term, the investor will be in detriment. This is called agency risk or agency cost. Now, Miller and Modigliani assumes that there are no agency costs, which means the management is ethical and works to maximize the investor's wealth. So no agency cost means management is working to maximize the investor wealth. There is no cost involved here. And the fifth assumption, the last assumption, this is the financing and investing decisions do not influence each other. The financing and investing decisions are independent. Let's say you have 100 bucks, but you want to invest 200 bucks, right? You want to invest 200 bucks. Now you can do two things. Either you can take loan of 100 bucks or you can wait for earning another 100 bucks, right? Now, usually what can happen is when you take a loan, you are more defensive. If you are spending your own money which has less risk, there are no interest payments, EMI payments, then you can take more risks. But if you take loan, you have a burden of loan, then you can take less risks. What this assumption is saying is that whether you take a loan or whether you don't take a loan, that means your investment decisions do not depend on how you source the investing funds. So whether you take a loan or whether you wait for yourself to earn another 100 bucks, your investing decisions is not influenced by that, right? This is what the fifth and last assumption is. Another important thing is when Miller and Modigliani make their propositions, they make it under two conditions as we have already spoken. One is with taxes and another is without taxes. Without tax, there is no tax. This proposition comes under the perfect market condition only, right? No taxes. In the second set of proposition, this part, no taxes part, is made flexible. So we consider what happens when there are taxes. So there are two cases. One is a set of propositions when there are no taxes, and the same propositions, how they change when there are taxes. This is what we'll look at. The rest of the assumptions remain same. Only taxes and no taxes. These two combinations or permutations we consider. Okay. Now let's get on with it. There is Modigliani and Miller propositions without taxes, right? There are two propositions. One is with respect to the value of the firm and the other is with respect to the cost of capital of the firm. Firstly, regarding the value of the firm, it says that the value of the firm does not change depending on the capital structure if there are no taxes. So, let's say there is a firm A which is having no debt, that is debt is equal to 0. And in another case, this same firm A has a debt of, let's say, 50%, right? Therefore, equity is 50% in this case. In the previous case, equity was 100%. Now, in the first case, let's say the value is VU, that is V unlevered, V without debt. And in the second case, let's say the value is VL, value with leverage, with debt. What Miller and Modigliani say is, value of the firm when there are no taxes is independent of the capital structure. That is, VU should be equal to VL. The valuation of the firm is not different in any case. You make the debt 10%, you make it 20%, you make it 80%, it does not matter. If there are no taxes, the value of the firm does not change. It remains constant. Okay, this is the first proposition. So let me write it down. So proposition 1, when there are no taxes, is value of a firm does not depend on capital structure if there are no taxes. So value of an unlevered firm, that is a firm with zero debt, is same as the value of a firm with little debt or lots of debt, right? But what does change? What changes is the risk of the equity holders changes. Let's say if a firm has 80% debt, the equity holders have more risk, so they will ask for more returns, or they will ask for more return on equity, right? This is directly related to the second proposition. The second proposition says cost of equity. Cost of equity is directly proportional to the amount of leverage, or cost of equity changes linearly with increase in amount of leverage. Cost of equity increases linearly with increase in leverage or debt. So let me write it down. Now friends, if we look closely at the first proposition, at the proposition 1, we can find out a few things here friends, if we look closely. First, let's see what is the valuation of a firm. How do we do that? Valuation of a firm is nothing but the present value of its future cash flows, right? Let's say the firm earns cash flows for n number of years, right? So in year 1, let's say it earns CF1, year 2 it earns CF2, year 3 it earns CF3, and like this it earns till CFN. Now the present values of all these individual cash flows, is nothing but the value of the firm at time 0. So this V is actually V0, value at time 0. Whatever future cash flows are there, we reduce it or discount it to the present value and we get this. Now how do we discount it? We discount it with the help of cost of capital. R. Now R has two formats. One is when there is no debt and when there is debt, right? So when there is no debt, the cost of capital is R0. When there is debt, the cost of capital is RWACC, weighted average cost of capital. So let's take the first condition, that is when there is no debt. So CF1 will be discounted by the cost of capital when there is no debt. So 1 plus R0 raised to the power the time period, which is 1 year or 1 period. CF1 divided by 1 plus R0 to the power 1 plus CF2 divided by 1 plus R0 to the power 2, because 2 periods have gone by, plus CF3 divided by 1 plus R0 to the power 3 plus plus the nth year's cash flow divided by the cost of capital when there is no debt raised to the power n. 1 plus the cost of capital when there is no debt to the power n, because n periods have passed by. So this is nothing but the V unlevered, VU. This is case 1 when there is no debt. When there is debt, case 2, when there is debt, how do we calculate friends? V0 or in the proposition we have written it as VL. This is equal to CF1 divided by 1 plus RWACC, weighted average cost of capital, raised to the power 1 plus CF2 divided by 1 plus R to the power RWACC, weighted average cost of capital, raised to the power 2, because 2 time periods have passed by, plus CF3 divided by 1 plus R weighted average cost of capital raised to the power 3, right, plus dot 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 plus the nth period will be, it's easy to understand, 1 plus RWACC divided to the power n, right. Now, according to proposition 1, the second case V0 and the first case V0 are same. Second case V0 and first case V0 are same. The second case V0 and the first case V0 are same because VU and VL are same, right? These two values are same. The cash flows are same in both cases, CF1, CF2, CF3, CFN, right? So, what is the other variable, friends? The other variable is R0 and RWACC. So for V0 to be constant, in both cases, these two also have to be equal, right? These two also have to be equal. R0 has to be equal to RWACC for the first proposition to hold, right? Now the second proposition says that in absence of taxes, cost of equity increases linearly with the amount of debt. Right? Increases linearly with the amount of debt. So we have to prove this. And we go about it. First we assume that the firm has debt. Therefore, we have to find out what is the R WACC. Let's find it out. So let's say the value of a firm is V. Its market value of equity is E and its market value of debt is D. Therefore, value of the firm is nothing but V is equal to E plus D, right? Now, weight of equity in this firm is equal to E by the value of the firm. Market value of equity divided by total value of the firm. And weight of debt is nothing but market value of debt divided by the total value of firm. Now friends, let's say RE is the cost of equity and RD is the cost of debt. Therefore, the weighted average cost of capital RWAC is nothing but the weighted average of RE and RD. We have seen this previously, which means this is equal to weight of equity multiplied by cost of equity plus weight of debt multiplied by cost of debt. This is equal to E by V multiplied by cost of equity plus D by V multiplied by cost of debt. This is equal to RWACC. But because unlevered firm's value is same as levered firm's value, R0 is equal to RWAC. So we replace RWAC with R0. So R0 is equal to E by V plus into RE plus D by V into RD. This implies we multiply with V on both sides. This gives us R0 into V is equal to E into RE plus D into RD. Equity into cost of equity, debt into cost of debt. Right? These are the market values, remember. E and D are market values of equity and debt respectively. And V is therefore the market value of the firm. Now, V is equal to D plus E. Let's write this down here. R0 into D plus E is equal to E into cost of equity plus debt into cost of debt. Implies R0 into market value of debt plus R0 into market value of equity is equal to market value of equity into cost of equity plus market value of debt into cost of debt. Now let's do one thing. We want to find out how RE is related to debt. So let's do one thing. Let's take this expression on the other side. So here we can write E into RE is equal to R0 dot D plus R0 dot E minus RD dot D. This expression, we have just reversed the expression and written it here. Now we do one more thing. This D and this D we take common. So R0 dot E plus R0 minus RD into D. This becomes the entire expression. Equity into cost of equity is equal to R0 into equity plus R0 minus RD multiplied by D. This becomes the entire expression. Now friends, if we divide both sides by equity, what happens? If we divide both sides by equity, that is E, this happens. RE is equal to R0 plus R0 minus RD multiplied by, now friends, R0 is constant, RD is constant. Therefore, as the D increases, D by E, this ratio goes up, right? If this ratio goes up, then RE also has to go up, right? If this ratio goes up, RE also has to go up. And this relationship is linear. You can see there is no to the power exponential or square or cube or anything like that. This relationship between RE and debt equity ratio is linear. So we have hence proved Miller and Modigliani's proposition number 2, that in absence of debt, the amount of debt that is D increases the cost of equity. Let us write this equation separately. RE is equal to R0 plus R0 minus RD into D by E. Now friends, each and every firm faces two kinds of risk. One is risk due to its own unique business nature, which is called the idiosyncratic or the non-systematic risk, and the risk due to the overall markets, that the overall markets may go bad. That kind of risk is also there, right? This is called the systematic risk. So the risk which is unique to its own business is called non-systematic risk, and the risk which is because of the entire market going through cycles, that is called systematic risk. And each business has both of them to larger or smaller degrees, right? Now, because of non-systematic risk, the more the leverage, the higher is the probability of default or even bankruptcy, right? The more the leverage, the higher is the risk of default or bankruptcy. And because of systematic risk, the higher the leverage, the more is the cost of equity. The higher the leverage, the more is the cost of equity. How? It can be derived from an equation called the Hamada equation. Let's see how that looks like. Let's say the beta of the assets of a firm, that is the volatility of the market value of the assets of a firm, is beta A, and the volatility of the market value of its debt is beta D. These two are related to the beta of its equity, friends. So these two, beta A and beta D, are related to the beta of equity, that is the volatility of equity market value also. How? Basically, beta of assets is the weighted average of beta of equity and beta of debt. So let's say the firm has a total value of V, its debt market value is D, and its equity market value is E. So beta A is given by value of equity divided by total value multiplied by beta of E plus value of debt divided by V multiplied by beta of debt. if you rearrange this equation, this equation becomes very similar to the previous equation of cost of equity. Let's see. This equation, when rearranged, like previously I have done here, it becomes beta equity is equal to beta asset plus beta of asset minus beta of debt multiplied by debt divided by equity, right? This equation, this previous equation, is called the Hamada equation. This equation does not take default into its consideration, but it takes the volatility of the market value of equity, asset and debt, right? And this looks uncannily similar like this previous equation that we had, right? So from this equation we can see if the debt to equity ratio increases, then volatility of equity does increase, that is the beta of equity does increase. Now friends, these are the two propositions of Miller and Modigliani under the condition where there are no taxes, without taxes. We have already gone through the assumptions. From there, only one thing we are going to change now. From without taxes, we are going to make it with taxes. So let's see what happens there. So Modigliani Miller propositions with taxes. Proposition 1 is regarding the value, right? Value of a firm increases with the amount of debt linearly, and that is the increase is equal to debt multiplied by the tax rate. The increase is equal to debt multiplied by the tax rate. This is the amount of increase. Let's say the value of a firm when it is unlevered is VU. Now it takes up a debt of D and its tax rate is T. Therefore, the value of the levered firm becomes equal to V unlevered plus D into T. This is the value of a levered firm. And this is proposition 1 of Miller and Modigliani when there are taxes. So let me write it down. Value of a firm increases with leverage by an amount equal to the debt tax shield. Debt tax shield is equal to nothing but the value of the debt multiplied by the tax rate. This is called the debt tax shield. Okay friends, how this calculation happens, you will get to understand when you specifically go into the income statements. Okay, let me do one thing. Let me demonstrate it here. Let's say a company has taken a certain debt and its present value is D. Now, it is, let's say, a n number of years debt, right? So 1, 2, 3 till n number of years the debt is there. And each year there will be a certain amount of payment, right? Let's say in year 1 there is a payment of D1, small d1. Year 2 there is a payment of small d2. Year 3 d3. Like this, year n the amount paid is dn, right? It can be the same amounts or it can be coupon, then ultimately coupon plus the principal. It can be any which ways. It can be equal EMI like this. Doesn't matter, right? There are payments after all. Now what happens to the income statement? Let's say the profit in each of these periods before payment of interest and taxes, that is PBIT, profits before interest and taxes in each of this period are P1, P2, P3, up till Pn. This is profit before interest and taxes, friends. Now, after interest payment, that is profit before taxes, we have paid the interest, only taxes are left. After paying the interest, what are the profits? This is equal to P1 minus D1 because we have paid the interest or the EMIs, whatever that is, financial costs we have paid, P1 minus D1, P2 minus D2, P3 minus D3, Pn minus Dn, like this, right? Now, what are the tax implications of these profits, friends? What is the tax paid in each of these periods? Let's see. In period 1, taxes paid is P1 minus D1 into the tax rate T. Tax rate is T. In period 2, it is P2 minus D2 into T. In period 3, it is P3 minus D3 into T. Right? Dot dot dot. Nth period, it is Pn minus Dn into T. So this is the total amount of tax. Now consider a second scenario where there are no debt. There is no debt, right? In this case, this D1 is not there, D2 is not there, D3 is not there, Dn is not there. These all payments, interest payments are not there, right? So the profit remains at P1 for period 1, P2 for period 2, P3 for period 3 till Pn at period n. These are the profits which remain. There are no interest payments, right? So the entire taxability will be on this entire profit, right? So taxes paid in the second case when there are no leverage or no debt, let's say the tax rate is T, this becomes P1 into T, P2 into T, P3 into T, dot 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 Pn into T. Now friends, consider one thing. Let's say period 1, P1, and let's compare the tax amount paid. In case when there is interest payment, the tax amount paid is P1 minus D1 into T. But when there are no taxes, the amount paid is P1 into T, right? P1 into T. Obviously, you can see this amount P1 minus D1 into T will be less than P1 into T. By how much? By D1 into T amount, right? D1 into T amount. In period 2, this amount will be less by D2 into T amount. In third period, the amount will be less by D3 into T amount, right? Right? So if you sum up all these amounts that is saved, it comes to be summation of all the Di into T. The present value of all this, let's call it dt. This is the tax shield, right? The present value of debt multiplied by the tax rate. And here your equation is understood better. VL is equal to VU plus the tax shield, dt. We have broken up the dt to understand it better. Now we move into proposition 2. In case there was no taxes, what was said, friends? Cost of equity is a linear function of the amount of leverage, right? When there are no taxes. And when there are taxes, what is the difference, friends? So the previous equation was cost of equity RE is equal to R0 plus R0 minus RD into D ratio. Here there is one minor adjustment due to the tax rate, which is you multiply R0 into RD into 1 minus T into D by E or DE ratio. This is the only adjustment. So here we write the cost of equity is still a function, a linear function of the leverage with an adjustment for the taxes or the tax rate. Let me write it down. The cost of equity still increases linearly with leverage, but this time there is an adjustment for taxes. And this adjustment is downward, friends, because we are multiplying by a factor which is less than 1, right? 1 minus t. So initially if the value was R0 minus RD into D by E, this time this entire expression is multiplied with something which is less than 1. Let's say 0.75 if the tax rate is 25%. Or let's say 0.8 if the tax rate is 20%, like this, right? So there is a downward adjustment. So the cost of equity increases this time also, but increases a little less. So these are basically the propositions of Miller and Modigliani, and we have taken both taxability and no taxability into consideration, and we have understood what is the tax shield, how it functions, how it impacts the value of the firm, how leverage and taxes influence the cost of equity, right? We have understood all of that.
Do you have doubts which you want to get clarified one-on-one? Doubt clearing sessions, mock tests, full curriculum related support, and counseling sessions. We have a bunch of enrollment options at Finavision. Do check out the link in the description and in the comment section below. Thank you so much, friends, for being with me in this video. If this video added value to you, do consider liking and subscribe to the channel. If you think that this video can be of help for someone else, do share it with them and do share your own feedback in the comment section. Till then, keep watching the videos on Finavision YouTube channel. Thank you so much once again.